Welcome back, everyone, to another Roundtable session as part of the None of Our Businesses YouTube show and podcast. As always, I have with me here Charlie Zigmund.
Hi, everybody.
And AJ Wheeler.
How's it going?
And we continue to be conferencing, Zooming from our home offices to get together and have this weekly discussion on current events. So let's take it away, guys.
The zooming reminds me of the old 90s song, zoom, 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 and a boom, boom. We'll shake with the articles. Anyway, my first article actually that came across my time.
There's been some jokes and stuff going around, of course, for, so now the saying is, are we discussing the elephant in the Zoom?
The elephant in the Zoom.
Let's let that one die right there.
All right, go ahead. Sorry.
It continues my long-standing assertion that accounting jokes aren't funny. No. Although that wasn't specific to accounting, maybe just business. Anyway, so CNBC. So this was actually the article sounds much different than what actually is said. Surprise, surprise. But small business loans above $2 million will get full audit to make sure they're valid, Muchin says. So, in speaking with the press during a daily briefing, the Treasury Secretary mentioned that he wants full audits of companies that took out more than $2 million. And so his exact quote is, "I'm going to be putting out an announcement later on this morning that for any loan over $2 million, the SBA will be doing a full review of that loan before there is any loan forgiveness. This was a program designed for small business. It was not a program that was designed for public companies that had liquidity," end quote. And so a couple things about his statement, I think, that caught me was, or the title of the article, I guess, and public persona about what an audit is and what an audit does, I think is the first thing that caught me as a former auditor. And the other thing that caught my eye was the fact that he's making the assertion that the program was designed for small business and it wasn't a program that was designed for public companies that had liquidity. But they wrote the rules, and the rules clearly stated that it was kind of for those companies because the rules were kind of written in a way that was so ambiguous. And I kind of wanted to get your guys' thought on both those issues, like kind of the public persona of what an audit is and does, and when that nomenclature is thrown around on an audit of what that means to the general public versus what it means to an accountant and a business. And then kind of the fact that the guy that helped write the rules is now saying the rules didn't accomplish what they were intended to. So anyway,
I think that's silly. Yeah, I think to have control over how you pick the rules and to set up this program and then kind of sit back and lament about how things played out while you had control is just, very silly to me. And, doesn't seem, it's kind of a thing we talked about in the prior podcast, but it seemed like they should have had more thought put into what the qualifications were so that they didn't end up with an outcome that they really didn't want. And so, I think that's an interesting stance to take once you've set up the program,
And I think, I think that, we talked a little bit about this in one of our previous shows too, about these rules and the ambiguity. I think this article just kind of doubled down on what was an ambiguous rule, and yet Mnuchin talks about it as if it should be clear as day, right? So, the rule was that you had to certify that you believe that the funds were necessary because of the uncertainties created by the coronavirus crisis, right? And so, that's a pretty open-ended, that you believe that they're needed, and that need results from uncertainty due to the coronavirus crisis. That seems like it to be able to establish that you need that, and then to certify that is a very open-ended kind of statement, right? And so then he goes on in this article, he goes on to basically say, he acts as if it should be common sense that if you're a public company with access to the public markets, that inherently means that you just don't need it, and that you just don't face uncertainty you have enough liquidity that you don't face the kind of uncertainty that they were talking about due to the coronavirus. And and so I think, yeah, I mean, I would say maybe that's obvious to 90% of our audience as well. But being somebody who likes to like draw within the exact lines given of the letter of the law and the rules that we deal with, it's not. I don't think it is that obvious. And if you're going to say that that's obvious, then is that where you stop? Is it just that public companies obviously don't need it? What else might Mnuchin or somebody else later say should have been obvious that somebody just didn't need it, right? And so I think that I find that kind of disturbing, because there is no bright line there, and I wouldn't say that being a public company didn't make that particular piece a bright line. And this is also something we talked about in one of our prior shows. I think the other thing that's disturbing to me on this is that they seem to be conflating this idea of liquidity and need and uncertainty due to the coronavirus with whether you're a big company or not. Those are really two different issues, right? I mean, if he's basically saying these public companies shouldn't have certified that they needed it because they had liquidity and they had availability of funds due to the being public companies in a public market, okay, but that's not a size issue. I mean, yes, there is a correlation between bigger companies being public companies and smaller companies often are not public companies, but there's small public companies and there's some pretty big private companies too. So being a public company or not being a public company is not inherently is not the size thing, right? And so it just sounds like a political soundbite more than like a technical definition still. And I don't think it furthers anything in the discussion on that particular point.
And I think really like it comes down to those two key phrases, right? Certify in good faith, and then also it was necessary. So given the global pandemic and kind of the uncertainty of all markets, including lending markets, capital markets, the only thing you could really count on as being certain was cash money in the bank. I don't think any large company could have sat there straight-faced and said, we have access to a capital market we know we can tap, or a debt line or an equity line that we for sure can tap, or have, in good faith know it'll be there.
100%. Yeah. Yeah. The idea that because you're a public company that you had certainty, that you had liquidity for the next 8 weeks, given the situation that we're in. I mean, that assertion by Mnuchin alone doesn't really totally make sense either. So yeah, I think 100%.
Yeah, it's silly because I mean, all these companies set their burn rates up around what they're spending and using. So yeah, there's no level of certainty that comes with being of a certain size. And yeah, it just seems like a silly stance to take. But I also appreciate just the idea of having to put out a soundbite that applies to a large, subset of businesses and trying to say the right thing that would apply. And so yeah, it's kind of hard to give a technical definition in such a quick soundbite. And so I think he gets kind of bit by that a little bit.
Yeah, I mean, look, we work with small businesses. I support small businesses. So I definitely don't want to sound like I'm on the side of, oh, this support should be there for large businesses, yeah, it burns me that large businesses, the way it was set up, large businesses were able to take this money and it detracted from the pool that the small business community had available to them. I do feel burned by that as well. I don't like that scenario. I think to blame it on the public companies to say that they just didn't understand or follow the rules correctly is just the wrong blame. It's like what you started with in the question, AJ. It's the Treasury. They wrote the rules wrong. That's who we should be blaming here.
Yeah, and I think it really points to the lack of specifics that were given in the original round of funding, because it was this kind of open-ended question like, in good faith, can you certify your uncertainty to meet payroll? And I think everybody in this country, or every business in this country, could have probably made that case, And even the caveat saying it's unlikely that a public company with substantial market value and access to capital will be able to make the required certification in good faith, and such a company should be prepared to demonstrate upon request the basis for its certification. I think it goes back to exactly the certification, the requirements to get certified were very broad. You know, you bring in what your payroll was, you in good faith sign that you needed it, and then that's that.
Well, and it also kind of just speaks to one of the challenges of trying to distribute aid during a pandemic. I mean, one of the problems is that they may believe a lot of these things about that companies should be able to certify with more accuracy, or they may want a system in place that allows them to perform deeper audits and understandings, but it's just they don't have the time to set up those kinds of systems, and so they have to set up rules that are, under thought out, I guess, in order to just get the system to run quickly. And so, yeah, that kind of transitions well into my next article, which comes from Reuters, and it's called U.S. Payroll Protection Program, What Has Changed in Round 2. And so this article takes a look at what they've, the initial pot of money that was given to the first round of PPP loan funding has run out. And so they're replacing it with a second round of funding. And they've made some changes to the rules to try to ensure that a lot of these things we're talking about don't play out the same way. Some of the things that they did were they made it so that it was that the funds were bracketed by size of assets of the companies. So they had 30 billion for companies under 50 billion in assets, and then 30 billion for companies between 10 and 50 billion in assets. And so it's just generally trying to set up a better structure so that the money goes to the right people. Another interesting characteristic they added was that not more than 10% of all overall PPP funding could go through any one bank. And this was just to ensure that one bank didn't take over most of the funding. And so it talked about some of the challenges that they had in the initial batch, where they had problems with people being able to even submit their applications. And so they're implementing a new system that allows the banks to batch their applications together. And so they're going to submit like 50 loans at the same time. And that's supposed to help them then get their applications in timely. And so, they said publicly traded companies can still apply, but they have to, like you said, certify that there is some level of uncertainty, which still seems, difficult to clarify or to say with, in a way that doesn't apply to every business. They did mention that hedge funds and private equity firms were speculative in nature and therefore couldn't apply for SBA loans. And so they've specifically taken that out. But yeah, I guess I wanted to get your guys' thought on whether or not you think these type of changes are going to be successful in implementing the outcomes that they're trying to do, which is to get the money to small businesses.
I think one of the changes that you kind of mentioned, but that I had heard of as well, was that they were earmarking funds specifically for small community banks. So they were basically trying to make sure that there was a certain amount that would go through them. And the theory on that was, well, if they earmark some of the funds specifically for small community banks, then that's more likely to make sure that it hits small companies. And yeah, I guess in the macro, what struck me about that is that's not like, that's kind of counterintuitive or counter to my personal experience. But I can see in the macro where that might be true. So I'm not saying it's not true in the macro, but I know in the micro, in the world that I live in the first round of the PPP, it was actually the businesses that were slightly more sophisticated, that had good kind of relationships with community banks, that actually got funded on the first PPP. It was those of businesses, including my own, that really treated banking, a lot of small businesses, micro businesses, you might say, I think treat banking as a commodity. So they don't go establish relationships with like some community banker, right? They don't, they just use a commercial bank. They use Chase or Wells Fargo or Bank of America or whatever. And I believe that's probably true for a lot of micro businesses across the board. And so I think that particular move by the SBA, probably, or not by the SBA, but by the rulemaking in particular, I think, I don't know that it really exactly serves the purpose that they're trying to make it serve, in the sense that funding it through community banks does a lot more to help community banks versus big banks than it does, I think, to help small versus big business. They could tackle the small versus big business a lot more directly by just putting more specific requirements on what it means to be a small versus big business, right? They could put requirements on revenue and assets and things like that. So yeah, it feels to me like there was probably more of just a community bank lobbying effort that caused more of that to be channeled through community banks. And you know, it probably is true that in the macro that community banks don't serve the largest companies in the country. And so that probably does mean that by earmarking funds that way, you do get more small businesses than funds to large businesses, at least for that particular chunk. But I think it kind of misses the people who were underserved, because I suspect that a lot of people who are underserved in banking, it's not because they bank with community banks. It's because, like me, they treat banking as a commodity and they just use some commercial bank that happens to have a branch around the corner. And now that's biting them in the butt because they don't have a relationship to use to get at the front of the line.
Well, and it's kind of interesting too, because I know that, like, from my personal experience with trying to help companies get this, there's a relative relational thing that's going on where it's like, yes, you might know Bank of America, you might have accounts with Bank of America or some other gigantic bank, but to them, you are small relative to their other clientele. And so what you're really seeking for is a differential where you are the larger client of a smaller bank, so that you have that chance to get to the front of the line, kind of a deal. And so it's just this interesting give and take on the relationship that that it's hard to manage from a regulatory perspective, it looks like.
And one other thing I think that is not really kind of said to the layperson out there, I think a lot of the business operators who may listen to this get this point, but when we talk about having a relationship with a bank, the most likely reason that any business has a relationship with a bank is because they're already borrowing money from the bank. So this whole thing already put a bias towards people who were already borrowing money. Any of businesses that weren't borrowing money, that all they did was use the bank to deposit funds, they probably didn't have much of a relationship with their bank or their banker. And that left them out in the cold. And that seems a little bit counterintuitive to me, that if you've been hitting up the SBA previously before coronavirus and you've been borrowing lots of money in various ways and growing your business, you're already in debt. You got to the front of the line by already being in debt. Right? I mean, that's actually the scenario. Those of us who weren't in debt to the bank from a business standpoint, we don't have relationships with bankers because we're not in debt to them to begin with.
Well, there's no better way to be better at getting into debt than to have practiced getting into debt before, and sort of puts you ready to be more in debt later.
That's right. And leave it to the U.S. to basically encourage us to be more in debt.